Welcome back to Infinity Podcast. Today I'm joined by John Citrigno, a seasoned real estate investor, developer, and capital markets veteran. With more than 3 decades of experience across brokerage, private lending, private equity, and ground-up development. John is a managing partner of Cirius Partners, a closely held investment platform. He's also the principal of Cirius Green Development, where his work is centered on what he calls Housing 2.0, high-performance, energy-efficient, design-forward, multifamily projects. In this episode, we're using John's Park West project in San Diego as a real case study to explore how experienced sponsors think about balancing downside protection with upside creation, and how sustainability, capital alignment, and design excellence all can translate into durable net operating income and long-term value. John, thank you for coming on the podcast.
Thank you for having me. Good intro. Thank you, Zeus.
John, for those of the people in our audience who do not know your background, how you got started in investment real estate, could you give us a quick introduction and how you ended up where you are now?
Well, I first got started in residential single family. After a few years, I found that I had more interest in the numbers side of the business than the emotional side, and decided to go from selling condos and single family homes to small apartment buildings. I started with duplexes, fourplexes, graduated to 10, 12 unit buildings, and over the course of 3 decades, graduated to selling larger institutional properties, not just in Northern California where I was based at the time, but across the country. We were doing a lot of 1031 exchange out of older mom and pop buildings into newer, larger 180, 240 unit projects in Texas, Oklahoma, different places like that.
John, across your career, you've seen multiple real estate cycles, 1995, 2001, 2008, 2020, and you've been across different seats, broker, lender, and GP. How has that shaped the way you think about development risk in today's market?
That's a good question. And when I just started with my, how I got into real estate, and I mentioned going from selling single family homes to selling multifamily, which was more, on the economics rather than the emotions, is that I've learned over the decades that people are people and they make decisions primarily emotionally, not just on the math or intellectually. And so one of the takeaways I have of the transition and growing into larger and bigger deals, but also in being a lender, a broker, for some intents and purposes, a property manager and appraiser, and now a developer, they're all interconnected because people are people, and it's ultimately a person that's making the decision. So as much as a lot of the highly sophisticated investors want to frame their decision on the math, I think a lot of it still comes down to, do we like the project? Do we trust the sponsor? And that's whether you're a developer, or in a sales position like a broker.
Across real estate, there are a plethora of different strategies that one can set their career on. What pushed you towards ground-up development focused on urban infill and sustainability now instead of the traditional value add or lending strategy?
It was the challenge, and also to be able to create and do something different and better, and take the years of experience and all the brilliant people I had the opportunity to represent when I was selling buildings. A lot of them were developers, and study their product and then roll it up into something newer and better.
It's amazing.
Yeah.
Tell us more about Housing 2.0, what it is, who it serves, capital partners, residents, cities, and how you view it.
Well, I think, Housing 2.0 is a book written by an architect named Sam Raskin, who was part and parcel to developing the Energy Star program when he headed up energy and home building sustainability for the Department of Energy. The premise of his book is that real estate is still being built the same way, pretty much as it was 100 years ago. With some materials that are better and tools that are better. But the processes are, particularly referring to stick build, are much the same. Whereas he says, look at how automobiles have graduated, and even more recently, computers and technology. So you've got technology advancing at light speed, and buildings being built pretty much the same way they were pretty inefficiently, 100 years ago. And so that's kind of one of the overarching premises. And I think that the what that leads to is a conversation about making everything more efficient in order to deliver a better product that's healthier, that's more energy efficient, that's sustainable, and a better lived experience for whether it's single family, the homeowner, or in our case, multifamily, the resident.
You came up with this concept called the yin and yang framework. Can you tell us what that means specifically in practice?
To me, the yin is, basics, bare bones. In the building industry, you might call it merchant built in order to get to affordability. Generally in an area that does have a good transportation corridor, but is not necessarily high rent, where the land is cheaper and you can build cheaper and actually create a product that is market rate affordable. Now, on the other hand, yang, which is what we're doing with the concept we led with Park West, is about beauty, about design, about luxury, about finishes, about making the product the most incredible experience that one could have, leading with a design eye, but not throwing caution to the wind and throwing resources at things that don't actually translate. Now, what we found is that you can have both. And even going back further, which is one of my own philosophies, is a lot of these people that are renting are never going to be able to afford to own. So why not make the place that they're going to live something that you'd live in? Why not make it as healthy and as nice as possible? And the way we're accomplishing that, which is why I say it's a combination of yin and yang, is affordability by way of downsizing the units so that they're a very efficient design, but yet having, say, we've got 9-foot 2-inch ceilings. So even though 80% of our units are smaller than 500 square feet, they don't look smaller than 500 square feet because of the volume and also because of the finishes. We're using a lot of whites and a lot of neutral colors. And then Raskin in his book, Housing 2.0, has a whole chapter on just how to design a home or a unit in terms of minimizing hallways, for example, to make the space in a home or a unit actually a smaller square footage, but actually physically more usable. Cutting out corners cuts out construction costs. So that's just one example of what we did. And I think that every unit that we have, whether it's a studio or a one-bedroom, junior one-bedroom, or a full-sized one-bedroom, or a two-bedroom, two-bath unit, are a roll-up of 3 or 4 decades of my experience and our partners of studying as students the layouts of every apartment complex we ever sold or owned or managed or walked through doing a rent survey. I think we've got the best 2-bedroom, 2-bath unit at 1,060 square feet in the market. So it's not just about being yang and having luxury, but also having it be, conversely affordable.
John, you recently mentioned that sustainability is not a moral overlay, it's a governing principle. I want to unpack sustainability in terms of the Park West project, how it comes in and then how you're viewing it in practice.
Well, I think it's both. I think that we have a moral obligation to be prudent in how we use resources. And I think that properly executed, it's not at greater cost or at a lesser result.
Agreed. From an operating standpoint, how do high-performance buildings translate into faster absorption, stronger resident experience, lower turnover, and more durable NOI?
We're not just builders and developers. We're also owners and operators. And the four of us have, of course, decades of experience. One of my main partners has owned a 68-unit apartment building in California for over 30 years. And so what you see is that over the long run, not just build it, sell it, but build it, hold it, and operate it, that to the extent that you can CapEx quality in materials and design to be greener and more sustainable, you're going to run a lower operating cost. And if you're able to demonstrate that and communicate that to a potential buyer down the road, they're going to feel more comfortable with the asset, see it as less risk, see it as more resilient moving forward, and pay a lower cap rate and a higher price for it.
To piggyback off that last note that you mentioned, I wanted to ask, how do these operational advantages show up at the exit, whether it's with cap rates, valuation, perceived risk, et cetera?
If you're in an A location and you're building to an A quality in terms of finishes, construction quality, and design, these are the projects that sell at the lower end of the cap rate in any market. In our market, which was not more than a couple of years ago, the A's were selling in the 3.5 cap range. Now they're in the 4.5 cap range. I'm not that familiar with the Texas market, but I imagine if you go to Dallas and the best neighborhood with the best building built by the best builder, that you're going to have a 100 basis points lower cap rate on exit than you would for a merchant built building in that market or in any market.
Yeah.
So there's generally about 100 basis points, which for those that don't understand what basis points is, that's 1%. And a cap rate of 4 translates into a higher price than a cap rate of 5. In our market, it's pretty much a 4 to 5 cap market. As I mentioned earlier, to the extent that you're building something better, I call it the Ford versus Ferrari. Nothing against Ford. I drive a Ford Fusion Energy, a hybrid. And then, by the way, it's a great movie, Ford versus Ferrari. It's one of my favorite movies. But the point I'm trying to make is that they both get you from A to Z.
Yeah.
They're both transportation. They both look pretty good. But somebody might pay 5x for a Ferrari over the Ford, maybe even more than that. I think Ferraris go for $750,000 plus. Some of them go for $3 million.
Right.
It's the same thing with real estate. People will pay a premium for quality or for something that has a brand that's associated with quality and value, and people will shy away from things that aren't built with quality.
John, one topic that comes up constantly right now amidst my conversations is yield on cost. Why do you think this causes so much confusion within development underwriting specifically?
Just to address confusion, it's what yield or whose yield on what cost. Is it taking into consideration when you talk about cost financing or just the free and clear unlevered cost of the building? And you'll get different answers to that question depending upon who you ask. If you ask a lender, they're going to include the debt, the interest carry. So again, it's just, to me, it's a rule of thumb. They all are. You have to. I think you have to look at them all together and holistically. But yield on cost is probably the most predominant metric for new construction. And what it means is if you spend $10 million in cost on the building and you have a $500,000 income produced by that building, then that's a 5% return or a 5% yield on cost. The yield on cost discussion pretty much is driven at a national level by Wall Street institutional type investors. And I don't disagree if you're looking at just hundreds, if not thousands of projects a year, and you've got to draw a bar. A good one is what we're hearing, which is don't bring me anything that's not a 6% yield on cost. And my reaction to that is it's not in Kansas. It's in San Diego. We've got an ocean view, and our costs are higher. The land costs are higher. The building costs are higher. In my market, I don't think that there's a true yield on cost that's coming in at 6%. I know for a fact several of our peer developers have recently completed projects in the 5 to 5.5 range.
Yeah.
And the other way I look at it is, would you pass on a property in urban core San Diego between the downtown on the south, the hospitals on the north, Balboa Park on the east, Little Italy in the Pacific Ocean, and the San Diego Bay on the west, over 1% yield on the project? In other words, it costs $10 million to build, and a 6 yield on cost is a $600,000 annual income. A 5, which is pretty much the market, especially untrended, $500,000. The difference is $100,000. But you have to couple that with the exit cap rate. And I don't think anyone's doing that, at least nobody that we've talked to. The project in Kansas would arguably be an easy 6, 6.5, 7 yield on cost.
Right.
But it would be a 5, 5.5, 6 cap on exit. In San Diego, we're looking at 5, 5.5 yields on costs, but you're looking at a 4, 4.5 exit. The bottom line being we see about 100 to 125 basis points spread between the exit cap rate and the yield on cost, untrended. But that only equates to a 1% difference in return on investment. And there's much more than a 1% difference between, not to denigrate Kansas, but can say Kansas and coastal San Diego.
John, talk to us about untrended yield on cost as a stress test versus stabilized yield on cost as a real economic metric.
The answer, like the answer to everything, is nuanced, and I'm going to try to keep this, concise. Untrended yield on cost is, as you put it, a stress test. It's really the way to look at it. What it does is it takes today's rents and operating expenses and uses that to get to yield. And you divide that without any change into the cost of the building. But it's going to take in California two, three years to build the building. When we look at construction costs, we're building in a contingency and inflation escalation because we assume that it's going to cost more to build, if we break ground in a year than it would today. No, that's not necessarily true. But generally speaking, it becomes a very, very unrealistically conservative metric of measure because over that same period of time, you can't assume that rents are going to be flat. Generally, the industry assumes a 2 to 3% annual cost of living rent increases. Well, we also know, been around a few decades, rents don't work that way. I've seen them be flat for 5 years and then go up 30% in 2. Yeah. That's what happened in 2020 with COVID. And now they've kind of scaled back a little bit because not as many people are working from home. But untrended yield on cost is basically looking at a worst case scenario. And stabilized is taking those rents out and making assumptions as to what you actually think they're going to be when you're renting the property up at the cost it will cost to build. So I think it's a truer number. I think there's a lot of confusion between stabilized and trended. A lot of the institutional investors say we won't look at anything if you're trending the numbers. And I used to scratch my head and ask them to define, what do you mean by that? And I had several large players send me their packages on what they said was trended. And I saw that trended is actually really different than stabilized. Stabilized is is taking today's rents and making reasonable assumptions about what they're going to be when you're actually built and renting the building up. Trended generally is taking those rents out 5 to 7 years. Yeah. So you can play a lot of games trending out 5 to 7 years. I mean, that's all about assumptions. And the farther out you go, the weaker those assumptions can stand the test of time. So I agree with the institutional investors that we shouldn't be looking at trended numbers, but I think it's grossly unfair to say, show me your numbers where your NOI is based on fully indexed property taxes, which in California take from the date of completion 18 to 24 months. What I mean by fully indexed is when you're building in California, your property taxes are based not on what the building would sell for, but what on the building cost to build. Usually cost plus 5% is what an appraiser will appraise it for. Untrended basically takes and fully escalates those property taxes right now today on today's rents and on tomorrow's costs when that will never happen in reality. In reality, it's going to take 3 years to build the building and another 2 years before you fully index your property taxes. So they're both good metrics. If something works on untrended, well, that's the unicorn that everyone's looking for. And if it works on stabilized, then it's probably a good investment.
How has the current capital? That's a great answer, John.
It's all academic, though. I mean, you have to look at more. You have to look at value, not just cost.
Yeah. John, amongst the capital conversations that you've had, what do you think sophisticated investors actually care about and look for today? Whether it be metrics, return structure, alignment, trust, sponsor credibility, et cetera.
That's a really good question, and I think that what they say they're looking for is different than what they're actually looking for. I think investors are using, for example, yield on cost, which we just discussed, as kind of the casting call, first slice.
Baseline,
Yeah, and they're eliminating a lot of good opportunities, I think, because I think you have to dig much deeper than that and look at it, from several different perspectives, the equate to value, and look at the assumptions that go into the numbers. But I think that ultimately, as I said when we first started this conversation, it's about relationships. I don't like to use the word trust because over the decades I've learned that it's probably a good idea not to trust anybody or anything. Trust but verify. I really think that it's about an alignment of purpose. And what we'd be looking for in our investors, and we like the more sophisticated, because we want to make sure that they know, when we explain something, that they're understanding it.
Yeah.
In the bigger picture, they are on the same page with us in terms of the mission and the vision, and that is to build the highest quality, the most efficiently, in order to produce the highest and best lived experience for the resident that may never be able to afford to buy a home, that might spend their whole existence renting, and make it nice. Because what that does is it builds brand, it lowers turnover. And in my decades of looking at thousands of operating statements, and actually had the good fortune of comparing, to cut to the chase, to the extent that you can lower turnover, there's nothing more that you can do that's more impactful on creating value, and creating what matters, cash flow and return on investment, from the financial perspective, than lowering turnover. Maybe I'm getting a little academic, but the point being is that to the extent that you can reduce your turnover and have happy tenants, you're going to be producing a much more resilient and stable cash flow. And that translates with all the other things that go into it, location, condition, tenant profile, and management, to a lower cap rate and a higher price.
John, what mistakes do you see new sponsors making when they're trying to optimize returns in today's market?
Faking the numbers,
Yeah.
thinking somebody's not going to notice. I think a lot of people don't, but we notice these things. There was one investment, before getting into development, we were lending as a JV partner primarily to young and upcoming promising developers. And we were working with one that, this is, what was it, 2021, 2022, when the interest rates kept going up. The NOI kept going up. And I guess they thought we wouldn't notice in the Excel spreadsheet, what was going on. So I just think what you need to do is for better or for worse, be truthful, do a deep dive, do deep research to be able to validate your assumptions. I think that's number one. But the most important thing you can do in life is to build relationships, because it comes down to not so much what you know, but who you know.
Who you know, yeah.
When
I first got into the business, that's the number one advice that I heard. Just build relationships, and they'll take you as far as you can go.
It not only doesn't take more effort or more time to be nice, to be good, to be truthful, to be straightforward, but it also creates a lot less problems. And in the long run, what I've seen is, people that aren't straightforward create a lot of problems for themselves and constantly get stuck off the side of the road dealing with damage control. And I ran a real estate private equity fund before getting into this. And, when we hit COVID, a lot of our investors said, hey, we know that you're going to do a great job, that regardless of the outcome, it will be the best. And don't worry if you can't get all of our money back to us. Because we know don't kill yourself trying to stress out trying to get everything perfect. But being who I am, I just I worked nearly for 2 years for free, got everyone's money back plus interest. But I just think that that's what you got to do, and that's probably the best advice I could give a young person. Yeah. And I think it's more particularly true now than in my generation when I was growing up, because the internet has made it so easy for people to prop themselves up as being experts and gain, clicks and eyeballs and create a brand without much substance behind it, without much experience behind it.
John, looking forward, crystal ball, within the next, say, 5 or even 10 years, where do you see the San Diego multifamily market?
I'd say it is the best multifamily market in California.
I agree. No.
A lot of people say they're going to laugh. Well, yeah, but it's in California. I think it has the best long-term prospects of almost any market in the United States. And I'll say that for 3 reasons. One, it's geographically bounded. We have Camp Pendleton on the north. We've got the Anza-Borrego Desert to the east. And we've got the Mexican border to the south. And we have the Pacific Ocean to the west. So we've got basically a relatively, compared to, say, some towns in your flyover, your red states, say Texas, where you've got an endless supply of land and you just keep expanding. That keeps your costs down, but it also keeps your the dynamics of your value longer term. I think a lot of people overlook the fact that there's a massive international cross-border workforce that can feed our San Diego market. I mean, I was surprised to realize that Park West is 25 minutes from the border with with Mexico at Tijuana. There's a lot of manufacturing. We're looking at steel modular. We're looking at wood frame modular, and there's a lot of that being built just across the border in Mexico. But the other part of it is where we focused within that market. Our submarket, Park West, is, like I said earlier, bounded on the east by Balboa Park, on the west by the San Diego Bay, the Pacific Ocean, the south by downtown. But most significantly, on the north, we've got two major regional hospitals. We got UC San Diego and we've got Scripps, and there's others. As a CCIM, one of the things that I learned in market analysis is that if you're looking nationally, you want to find a regional community that has a major university. San Diego, we've got at least 3 major regional universities, 5 major regional hospitals, 2 of which you can walk to from our site. What nobody's talking about is AI. I think AI is a greater threat to middle market and upper market, urban and suburban multifamily rent resiliency than any other single factor. What I mean by that is what I saw over the last couple of years in San Diego is that rents, when we first started looking at San Diego, were much like they were in the Silicon Valley, a little bit to my surprise. But what had happened was, because of COVID and because of being able to work from home remotely, all the multifamily in the urban core of San Diego, especially the nicer product, filled up, and rents increased 20% overnight. Well, when companies started mandating that you had to come back to work to the office, that unwound itself, and rents have dropped 10% over the last 2-3 years, and are relatively flat now. In our performer for Park West, we're forecasting no rent increases for 2026, only 1% in 2027, 2% in 2028, so roughly 6% over the next 4 years. I think that's realistic. But what I think will anchor the project from the threat of losing our residents who lose their livelihoods to AI, which are a lot of the people that can pay $3,000 and $4,000 a month. They're work from home consultants, is the fact that you can walk to the hospitals. And with the baby boom getting older, and with the way the health industry underpins the market, I think that in particular makes the Hillcrest, Bankers Hill, Park West area that we're focused on rather resilient to the winds that we're going to see from AI. And I think if there's anything that we've talked about today, I hope that catches the attention of some folks, because I think it's a real thing. Now, you're not going to have that problem with your entry-level rents, but that's another reason why 80% of our units are below 500 square feet.
Yeah. Is
because in our market, our one-bedrooms are $500 a month less than any other one-bedrooms in Park West for new construction. And as a result, I believe we're going to have no problem absorbing.
Where do you see the capital markets within the next 2 years?
Equity doesn't sit on the sidelines forever. And I think all the indicators are that depending upon the market. I just saw an article yesterday that we're 3 consecutive years in a row on a national multifamily level undersupplying the market. And it's going to take another 1 to 2 years to absorb what happened, 2, 3, 4 years ago in terms of oversupply. But it's just like timing the stock market. Yeah. What do they call that? Dollar cost averaging. Mm-hmm. So I think for the larger institutional players, I think they have to still continually make smart choices. And I think if you're smaller, more of a high net worth individual or family office, look for value, because value always pays. So on a case by case basis, your Yangs, your amenity rich design forward projects that are catering to the middle and upper markets are going to be fine, on a very select basis. If you want to go in broad strokes, everybody's running towards affordable housing, whether it's subsidized or market rate. Yeah. That'll probably get crowded. Everything does. That's good. But our plan there is, again, to combine the yin and the yang and do market rate affordable that's a superior lived experience at that price point. So I think there'll be quite a demand for that. I think a lot more capital will start moving into the market. It's been on the it's been in the bleachers for too long.
Agreed. John, if you had to summarize the Park West project in one sentence, what would you say it was?
An opus. What Robert Mondavi did with wine when he did Opus 1. A nice combination of a Ford and a Ferrari. A good combination, a good harmony between yin and yang. And I think it's going to be a very successful project.
Awesome.
Yeah. Thank you for asking.
Yeah. If, for the last question on the podcast, if you were to go back, say when you started out in real estate at 22 years old, what would you have done differently?
Gone to medical school and become a doctor. No, I'm just kidding. I'm just kidding. Rather than being challenge-driven, maybe you just stayed in brokerage. Good money, low risk. But no, I don't know. I think I've been fortunate to have lived a great life to this point. I think that I wish that when I was in my 20s, I would have bought a fourplex instead of a Mercedes. The Mercedes went down in value. The fourplex went up. And I think as we talked in the hallway on the way in here, I think investors put too much emphasis on these metrics. I think they're good, but they're just rules of thumb. For example, I spoke once about cap rate. And the only, the point being it's just a rule of thumb, it's a metric. And the only time that, because there's so many assumptions that go into these metrics that a cap rate's accurate, is on a triple net lease, where the income you get is the NOI without any assumptions on a triple net lease. So metrics are good for measurement, but I think the bottom line is that when somebody's buying a piece of real estate, they have to know that they're the person that's willing to pay the most for that property. And I don't know of anyone that I sold properties to 10, 20, 30 years ago that regret that decision, paying top dollar at the time.
Yeah.
Over time, the higher quality assets that are better maintained hold their value and increase their value better than ones that seem like a better bargain on cap rate or yield on cost. But it's been a great ride.
Yeah. Thank
Good
you.
question.
Where are people able to find out about you, your project they're working on in Park West and Cirius Green development?
Well, I'm on LinkedIn, John Citrigno, Citrigno. We have a website, www.ciriusgreen.com. It's password protected, but if somebody wants to send me an in-mail through LinkedIn or an email, john@ciriusgreen.com, and Cirius is spelled play on words, Cirius, green.com. We can have a little chat, see if we have an alignment of interests, an alignment of mission, alignment of purpose, and if we do, let's rock and roll. Make it happen.
Thank you, John, for coming on the podcast.
Thank you. Thanks for having me.